All right, my clock says 11 o'clock. We'll go ahead and get started. So thank you everybody for joining us. We wanted to put this opportunity out because we've had a lot of questions, of course, about what big beautiful bill is going to mean. And I always like to reference my crystal balls. None of them work in the conference room still yet, so we don't know what's going to happen. But we do have some ideas about how you can take advantage of the environment that some of this might create. And I reached out to my friend Kim Arthur out there in San Francisco. He is the founding partner and CEO of Main Management, which is one of the asset managers that we use as a core in most of your portfolios. Kim's the most delightful person you'll ever meet, but aside from that, he's also one of the biggest, best brains I've ever encountered. So really appreciate him taking some time with us today. Hopefully you all had a chance to read his profile and understand who's speaking with you, but he has been profiled in Barron's, Wall Street Journal, Fortune magazine. This is where Kim can start blushing if he wants. But really, you have access right now to an incredible mind and a wonderful person. And Kim, I'm going to let you take it from there and share with us your thoughts about what all of this means and opportunities that you're seeing.
Shabali, thank you very much for that very kind introduction. Really appreciate it. And I want to thank you and all of your clients for the partnership that you have with Maine. I also just want to mention, I've got one of my partners, Chase Smith. Chase, give us a wave there. Yeah, Chase is on the line here. Great resource. And again, one of the partners here, one of the team members at Maine Management. So, again, what I was going to try to do is kind of cover the one big beautiful bill and its impact on the market on a kind of going forward basis, and try to highlight some of the features about it, and also to try to talk about how that positions the economy for the bull market that we still believe that we are in. So I'm going to kind of run through some different data points that we have, and then, as Shabali said, if there's questions, you guys want to put them in the chat piece there. We'll try to answer everything we can. So first thing about it is, at the start of this year, there was a lot of skepticism as to whether or not that bill would even get through by the end of this fiscal year, by the end of the calendar year. And as we saw, it was put in over the 4th of July weekend, and it had all the features that people were hoping it would have. We had lower taxes that were made permanent from the 2017. I'm going to give you some data points on that in just a second. We had lower regulations that were put through, and we had the feature where there was immediate expensing for capital expenditures, which are sort of the bread and butter to kind of continue to build the base to have earnings growth that would happen. And all of that got wrapped up. And obviously in April, just 3 months before that, when we were going through the Trump tariff tantrums, and the market bottomed down 20%, there was a lot of skepticism as to whether or not we would even have a bill, because there was going to be so much confusion over the tariffs and the rest of it. So it has come through. One thing to point out on the tax side, which I think is very, very interesting, if you look under Trump 1.0, when the 2017 tax bill was passed, the impact was very consequential across all income spectrums. Okay, and what do I mean by that? If you look at the bottom quartile, they actually had a $4,000 increase in real incomes. Okay, a lot of that was because taxes were cut. There was no inflation that was going on at that point, so they had a real lift. At the middle, the average was actually $6,400. Okay, this all comes from the Census Bureau, where you can look back at the data. And then the top quartile had $9,800. Okay, so it really had the impact where everybody's taxes were cut. Okay, so having that permanent is obviously going to kind of continue that situation. We then went through kind of an inflationary spike that happened during kind of the 21 all the way through into where we are now in the high twos there. But that inflationary period, that really hurt people's real wages. You had negative real wages that finally flipped positive 3+ years ago. That was May of 22. So we're running 3+ years with real wages. Why are real wages important? Real wages are important because 70% of the economy is the consumer. And if the consumer doesn't have real wages, it's very, very hard for that 70% to grow. And if you look over a long sweep of time, like the last 20 years, real wages have compounded at about 1% a year. So you don't need much in the real wages. And that's probably about where we're running right now is you have wages are up in the high threes and inflation's in the high twos. So that delta, that change, their real wages are positive 1%. And that's very, very, very key to continue to have that. The regulatory piece here, again, they're trying their best to try to decrease regulations. They're trying to make it more, make it easier for businesses to conduct business. Okay. And that was another kind of feature back in April where people were very concerned that the economy was going to go into a recession because of this tariff situation. And we like to say you want to try to filter out the noise, and the Trump administration has a giant aura of noise and try to grab the signal out of it. And his signal has been pretty clear because it's the same mandate in Trump 1.0. It was lower taxes, checkbox, lower regs, checkbox, and lower input costs of fuel. So lower energy costs, given that it feeds into so many pieces in the economic cycle there, that's extremely important. And that was why in April that was a correction, not a crisis. A crisis is defined as like the great financial crisis where something breaks in the economy and you're going to have a big disruption of earnings and have a recession. A correction is where people think you have a crisis, but it's not. They've misread. The noise has kind of altered what the actual signal is. This immediate capital expenditures, it's very, 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 very key. If you look since the start of this bull market, which again was October of 22, we're about to lap our third year next month. So we have about another 6 weeks until we lap that. But during that period, the little short of 3 years, if you look at capital expenditures, the biggest single piece is R&D. R&D is almost $900 billion. Okay, that creates the innovation. It's what makes American exceptionalism is R&D and risk taking. That's grown at about 7 or 8% since the start of this bull market. But this bill passing here with immediate expensing here, you're going to see an acceleration in R&D. We're going to see an acceleration in R&D. If you look at computers, those have grown at a big clip here at about 56% in the last 3 years, and that is a big portion of that. That's only about 250 billion. It's about a quarter of what the R&D is, but a lot of that is a new product cycle that's kind of come through. Software is as large as R&D almost. It's about 750 billion. That's been growing at about 17%. AI will actually accelerate. I believe there'll be winners and losers, but you need a lot of software for implementation of AI. And I think you're going to see the growth there. So all of those vectors, which now if you look of every dollar in CapEx that's spent here in America, over 50% is technology related, and that's a huge productivity enhancement. And we do think we're in the midst of a big productivity cycle that's being accelerated again by this one big beautiful bill. And over long sweeps of time, productivity goes from 0 to as high as 4%. And those highs of 4 you get at the end of a tech cycle. So the first tech cycle was in the late 50s, mid 50s, when IBM launched with the mainframe computer. And that kind of had a halo effect for the next almost 15 plus years. And we peaked at 4% in the late 60s. Then the next cycle started in the early 90s with the internet, and that peaked in 2000 at 4%. We're right now at 2%. We're only halfway there, and we think that AI over the next decade is going to drive us up to that 4% productivity. And productivity is key because what happens to have gross domestic product, have the economy grow, you need two things. You need the labor force growing, which it's not right now. We'll talk about that in a minute, and productivity. So you need both of those pieces together, and productivity is kind of doing the heavy lifting right now and will probably continue. So that's sort of from the high level what that one big beautiful bill is supposed to do. If you look and you kind of come down lower and say, okay, what's the impact been right now and what will it be in the next 12 to 18 months? So the impact in the first half of the year when the bill was not passed, we had GDP that was running at about 1%. Okay, long-term trend line has been 3% for the last 100 years, but recently it's been more around 2 as we're kind of getting ready to ramp up this AI, which should take it back to above 3. So we were 1% GDP growth in the first half of the year, but the earnings still grew at 10+%. That's key to think about for a minute. The second half of the year, where you will get the impact starting with this bill, the GDP right now looks like it's going to be more like between 2 and 3%, and earnings estimates are only for up 7%. That's not going to happen. You're going to either have GDP that's lower, which I don't think is the case, or the earnings higher, which I do think is the case. So we think that, and again, just a quick summary on it, bull markets start when you have valuations that are very, very cheap. In this case, we started at 15 times. That was 3 years ago. We've now moved up to where we're 22 times, which looks rich historically. But if earnings are growing like they are above trend at 10%, you can maintain those multiples as long as you continue to have that growth. And again, as I mentioned, we grew the first half of the year at 10% with only 1% GDP. And the back half, we should have twice as much GDP, and they only have estimates of 7%. It'll probably end up being more like 10%. And then carrying over to 2026, we should have a full year that could have GDP at between 2 and 3%. And that means that your earnings will probably be able to grow at another 10% clip and maintain the bull market. So that's the first piece on that. I mentioned the recession odds, where at any given year, there's on average recessions happen once every 7 years. Again, that's an average. Those are deceptives, which means it never happens in a sequence of 777. But that means any year you have about a 15% chance of a recession. The start of the year, people were expecting 15%. They just said this is an average year. There's a 15% chance of a recession, meaning 85% chance of no recession. By the middle of April, when people were panicking over that Trump tariff tantrums, they thought that it was 65% chance of a recession. That's why we had a 20% correction. The market had already priced in a recession. And the reason why the market came right back is no recession happened. So we're now looking, the market has a 9% chance of a recession. And again, part of that is, again, with the passage of that bill, lower taxes, lower regulations, and immediate expensing. So that's a big, big piece there. I mentioned on tariffs, this will now go to the Supreme Court. The Supreme Court is going to decide this, if these are legal, if the president has the ability to enforce that, or if only Congress has the ability. That's going to be the question that the Supreme Court rules on. Right now, there are about $400 billion of extra tariff revenues on a forward basis. So before these negotiations happened, there was less than $100 billion of tariff revenues coming in. Now it could be closer to 500 billion if they are allowed to be legal. And those tariff revenues are being used to offset the deficit spending that Washington, D.C. has. And again, Washington doesn't have a revenue problem, it has an expense problem. And what I mean by that, if you look at the revenues as a percent of GDP going way back, they've averaged 17.5%. Today, they're a point above that. They're 18.5. So revenues are actually higher, and that's in spite of those lower taxes. In fact, most of the time when taxes are cut, revenues are actually higher. It seems counterintuitive, but what happens is people get more productive. People don't try to hide things there. If they think it's a reasonable tax rate, they'll report it. The expenses, on the other hand, are the problem. Over the long sweep of time, this goes back to 1950, expenses have averaged 20.7%, meaning that you've had a deficit of about 3 points a year, which the market can handle. But the expenses currently are 4 points above. They're at 24.2%. So that's why we have almost a 6% deficit. And that is the problem there. It's on the expense side. DC keeps telling you it's a revenue problem. It's a revenue. Revenues are pretty, again, they're above the historical average. It's the expense side that's the issue here. So again, that extra 400 billion of tariff revenues, that is being used to offset part of that expense side there. So it is very important from a structural standpoint that those hold. I personally think that, listen, I'm not a huge tariff person, but if you look at it, a tariff is a tax. Taxes destroy demand or cut demand, but these tariffs are being split between the manufacturer overseas, about 1/3, the importer about 1/3, and the consumer about 1/3. So that means the consumer has an incremental, an additional $130 billion, which may sound like a big number. It is a big number, but the economy is 30 trillion. So this is less than 2%. It's a very small kind of tax that's been put on, and that's why the markets are trading at all-time highs, because it's adjusted to that now, and it realizes that it's a one-time step up there, and then it kind of becomes embedded in. So I think the tariffs are, we'll see what happens. If they get knocked down at the Supreme Court, I think the next thing, plan B, would be they would go to Congress, which right now it is a Republican-controlled Senate and House, that they would then attempt to pass it congressionally. That would be my guess, would be their plan B if it gets knocked down at the Supreme Court. The other thing that we have going on here is, I mentioned earlier, you've got the labor force. The growth for GDP is the increase in labor force and productivity. Labor force is flat right now. And why is that? Because the borders have been cut off. They've been sealed off. There's no illegal immigration coming across the border that we had for the last 4 years that caused the labor force to grow. So that means that when you have non-farm payrolls that they report on a monthly basis, and tomorrow will be for August, those numbers, you don't need a lot of new people to keep the unemployment rate at 4.2%, because there's no new added labor force. So you could have like 35 or 40,000 people is all you need to be added to the payrolls, and it doesn't cause the unemployment rate to go higher. That's a key thing to keep in mind there, because most people think that you need like 80,000 or 100,000 new jobs every month just to tread water. That number has dropped down significantly lower. It's probably, again, closer to 40,000, could be even 35,000. So it's significantly lower. I mentioned two other things, and then I'll pause for a minute there. Is, again, once you get the multiple on the market, this one started at 15 times and it's up at 22 times. You need earnings to grow. We've been growing the earnings at about 10%. The beginning of the year, the forward earnings for the market were at $272. 8 months later, we're at $292. So they've been growing at about $2.50 a month, which means that by the end of this year, the forward projection would be over $300 in earnings, over $300. And that's where we get a price target that's about 6,600 for this year, and for next year it's about 7,400 on the S&P. So near term, there's not a lot of upside potential here. And it is, but if you look out 12 months, and I think you have to, like, when you kind of put your lens on, you need to be looking kind of forward 12 months. And if forward 12 months, it still looks like there's 10+% upside for the market. That still looks attractive. That still looks attractive. I know you can get paid 4% in risk-free money market accounts. That'll start to drop if the Fed's cutting rates, but you can get 2x that in the S&P probably on a forward 12-month basis. So I think those are interesting. In the press right now, everybody talks about how scary September can be. You hear all these things. September's a scary month here. Again, averages show that on average, September is down less than 1%. So it's not super scary, but it is a down. But this month has a unique feature where the Fed is supposed to cut rates on the 17th of September. The only two times in September that the Fed has cut rates were 1998 and 2024. And both of those months, the S&P was up. It was up 1.5% in 98 and 2.5% last month or last year. So not all Septembers are created equal. I don't know for sure if the Fed will cut rates. Right now, the market is saying there's about a 97% chance that they'll cut rates. Tomorrow, with that non-farm payroll number, the payrolls number, they will adjust that. Again, if it's a bigger number than 100,000, maybe they won't cut rates. If it's smaller than 50,000, they'll definitely be cutting rates. So those are the pieces that we kind of have. So maybe let me pause there for a second and see if there's some specific things that maybe I didn't cover that would be worth doing or clarifying some things.
Yeah, if anybody has questions about anything so far, the Q&A is open. That's up on your left, the top left of your bar, if you want to put a question in, or you can raise your hand. There are few enough of us on here. If you want to raise your hand, I can unblock your mic so that you could just ask the question. Does anyone have a question right now? Okay. It's interesting on the Fed. I'm always curious how the Fed's going to cut rates, because that, of course, makes a big difference in how we're planning allocations and, where rates are going to go and how much that short-term money that clients are going to need in the next 24 months, where we have the opportunity to place that. Back when we had, really zero rates for years and years, there was no place to put short-term money without, too much risk assigned to it, and we really couldn't get any interest on it either. So rates falling is always a tricky thing. So I'm always interested in that. So 97% chance of rate cut. What's your bet on how much they cut?
I think again, if this non-farm payroll number comes in at 75,000 to 100,000, that they could get away without cutting rates. But I get the feeling that they're going to do a ceremonial 25 basis point cut. That now, if for some reason the numbers came out where there was no job growth at all, which I don't think is going to be the case, but if that happened, then you would probably see a 50 basis point cut. But I think enough of them are kind of worried that we've seen kind of some slowdown in hiring. It's taking longer for unemployed people to find a job. It's interesting on AI, its biggest impact that we've seen is actually at kids coming out of college. And if you think about it again, kids that come out of college are, with all due respect, I got 5 kids, 2 that are out of college and 3 that will be going in. So I can say this without sounding like I'm just that crazy. But when kids come out of college, they're really interns. If you think about it, wherever they're going to go get hired, they're essentially a glorified intern, which there's nothing wrong with that. But AI is replacing a lot of those intern pieces. And so if you look at the unemployment levels for kids coming out of college, it's starting to lift where the older cohorts that are in the labor force, they're not as negatively impacted by AI. They're using AI to be more productive. So kids are going to have to find ways that they can complement AI and make themselves, relevant again. Which is why, again, there's plenty of kids that they're like, if you want to be a plumber, an electrician,
Right.
AI is not taking those jobs. Those are
Right.
there's huge openings in that area. So I think again, you're kind of looking at like a 25 basis point cut. We're still a little restrictive. If you think inflation, let's even call inflation 3%. If you're a 1.37 above inflation, that's restrictive rates. If you look over in Europe, they have a 2% rate and they've got 2+% inflation. So their rates are below the inflation. We're still 137 basis points above. So I think you could do a 25 basis point cut, and it's not going to do much in the market, but it would help out. It helps out people with credit card debt. It helps out people with car loans. That's what it's
Yeah.
going to potentially impact. Whereas the 30 or your mortgage rate is impacted by your 10-year. Your 10-year, which probably won't move much off a rate cut.
Yeah. Well, the people I know are buying a house right now aren't on the call, so they won't. We don't have tears yet. So
yeah, we have to. If there's some way they can get, because historically mortgages should only be like 1.7 points above a 10-year. So if you looked at that, you would have a mortgage, a 30-year mortgage should be 5.9%, not 6.6. If it were 5.9, anything below 6%, I think you would stimulate a lot of demand. I think there would be a lot of people that would kind of come off because the affordability is not good right now, but a 1 point drop, which again would be, you wouldn't have to move the 10-year. It's just the pricing of these things it's sort of like a spread. The spread is way bigger than it historically should be.
yeah.
So they got to find a way to cut that down.
Well, and with rates coming down, we should actually see bonds start to try to do something again too. Instead of I had a lot of meetings with people coming in with the complementary portions of their portfolio that you're not managing,
Right.
wondering why we don't just give you everything, right? Because
Exactly
yours is
right.
doing so well.
Exactly.
And these poor bond managers are just like, what do you want us to do? So, so yeah, pros and cons and everything, right? Pros and cons and everything.
100%.
So, all right. Well, does anyone have, in our conversation here, anyone have any questions for Kim? Otherwise, I'm going to just hit a couple of the high points. A lot of people are wondering kind of what are the main points that are likely to affect them in the bill as far as tax management.
Yep.
Kim, do you have any parting thoughts on that, or any areas of the tax impact that you think might change how you guys are managing, especially growth oriented portfolios? Sometimes there's a link there, sometimes there's not. What are your thoughts?
Yeah, I think there definitely is a link with the growth portfolios for sure, Shabali, because again, going back to that immediate expensing, you're going to have I think there's two things that impact it. Not only the immediate expensing, but the consumer and small business confidence, which has been very, very low. It's very unusual this late, 3 years into a bull market, to not have consumer confidence higher. And in broad numbers there, that consumer confidence is at 100. That's the average going back. When it gets elevated and peak, it goes to 140. So there's a lot of room for that consumer confidence to go up. And I think a lot of that has to do with the overhang of inflation and the overhang, the uncertainty that's out there. So that's going to begin to change. Small businesses that can immediately do it, their number is around like 98, which is, again, they're only on average. They should be well above average for their confidence. And this new bill is going to allow them for this immediate expensing. It's going to allow them to start getting more excited about investing in their business. And I think that is going to show up, I think, from people's, tax standpoint. There are some, some features that you definitely, I'd have you talk to your tax accountant, because I'm not a tax accountant, but there clearly are things in there that are stimulative from an individual standpoint and some features you can do. But I like looking at the business side, how it's going to impact the earnings and how it's going to impact the economy and the markets. And all of those definitely are pointing towards a more robust small business participating and joining the larger businesses that have already been kind of participating in that area.
Right. And I think one of the pieces of that that definitely impacts that small business is that continued the extended 20% deduction for pass through. That's a really key piece that was added in there. And I think a lot of our clients are small business owners. They're running very small things, but that does impact them and allow them to, reduce their overall tax expense.
Yeah. Yeah.
Another key thing that came in that I think is really interesting that maybe a lot of people don't know about is for those over age 65, there's an additional $6,000 tax deduction per person, subject, of course, to income limits. And that's where your accountants come in because we don't give the tax advice there. But that is per person. So if you're married and you're under the income threshold on that, that'll allow you to deduct an additional $12,000 over the next 4 years. So that's something to make sure that is on your radar and your accountant is taking advantage of that. And then the other thing that I think will impact most of my clients is the expanded interest deduction allowance for certain kinds of cars, and also the SALT, the state and local tax cap of 10,000 has been, of course, increased to 40,000. So for those of you who were capped out and could only deduct that 10,000, you may have additional room now to take a deduction for some of those other local taxes that you've been paying. That also, and interestingly, it's so interesting that this bill made so many things permanent, and then so many more now have the 4 and 5 year limits on them, or they're going to expire in 4 or 5 years. But I suppose, nothing's really permanent anymore anyway, is it?
Exactly. 100%.
And then the estate tax exemption, having that made permanent at 15 million, that's a big deal for many people who, maybe inheriting and planning on their estate tax plan right now. And then, hey, you know what? I'm going to be really interested down the road here because it's just new, but the Trump accounts, these are going to be an interesting tool to see how those pan out. And those likely will be something that's available to most of my clients, either for grandchildren or for new babies that are born between now and 2028.
Big time. Yeah, for the $1,000 that you can put in there.
Exactly.
Yeah.
Exactly.
Yeah.
And then interestingly, I'm also going to be curious to see how employers do or don't take advantage of that ability to put up to $2,500 into one of those accounts for their employees. How they administer all of this and the tracking on it, that's going to be interesting too.
It's very interesting. But it does seem like that's an easy feature that a lot of employers, I think, to kind of it's not a high hurdle for them to be able to potentially offer that.
Right.
But to your point there, we're going to have to see some fund administrators that are going to have to come in here and they'll go ahead and provide easy buttons for employers to be able to put it in place.
For those who aren't familiar with that, it's essentially a Roth. It's a Trump account. It's going to act like a Roth for the first 18 years. So when they're born, government puts in $1,000. You're able to put in, starting July 4 of next year, up to $5,000 a year until they're age 18. That grows tax free. And then after age 18, it essentially turns into an IRA. So it would switch to growing tax deferred. But then those funds would be available for, just like an IRA, they would be available for tuition for school expenses and also for first-time home purchase. So it's going to be a debate about which is more valuable to, for college planning, to have the Trump account or to go ahead and continue to fund your 529 for the grandkids and the kids. But those are obviously case-by-case conversations that we'll have in your meetings over the coming year. So. All right. I know we had one other question about whether or not the Medicare provisions in this are going to harm rural hospitals. Kim, is that something that you've looked into much? Is that?
I have not, Shabli. I have not looked into that. What I would say, and this isn't specifically for that question, but it's broader based in healthcare. I think that AI is going to be hugely price disruptive for healthcare on the
Mhm.
positive side. It's going to drive costs down. And if you look
Mm.
at healthcare in general, healthcare and education have a feature that is, well, we know that over the long sweep here, they've had inflation significantly above the CPI, way, way above. And the
Mhm.
reason is if you look at the increase in administration in healthcare and the increase in administrative positions in education, it has grown exponentially. It's been a huge piece there. So there will be disruptions on the AI ability to kind of replace some of that admin side
Yeah.
there at a much lower cost. And there'll be kind of transition where some of those people they'll get transitioned into other potentially higher paying jobs, because that's usually what happens over the long sweep of technology changes, is that jobs are displaced, but there's higher paying jobs that replace them.
Mhm.
But I think that that's something that we'll look at. And it's interesting, 5 years ago or 3.5 years ago, people thought that radiologists would be put out of business because of
Yeah.
AI. And actually, what's happened is the pricing for the MRIs and the other things that they're reading, that's collapsed there. And you've actually had increased utilization of it. So there's been more utilization, and you had to increase the number of radiologists. So
Interesting.
I think it's interesting. People get scared on tech that it's going to kind of do things, but I think overall you'll have better healthcare providing. It'll be lower cost, and you will probably have a surge in utilization to begin with. But the rural hospitals on Medicare, I don't have any. I'll see if we can look around in our research and find anything, but I don't have anything specifically on that.
Yeah, I think from what I've looked at on that one, it's really more tied to that Affordable Care Act tax credits that are expiring as part of this bill. And so, on the surface, no doubt it will have an impact on some of those smaller, more rural areas. But to your point, there are a lot of counterbalances that could come in and make a difference. So
Yeah.
it's really one of those time will tell kind of stories. And unfortunately, if anyone has ideas for making my crystal balls work, I'd really dig that.
Yeah. I would make a recommendation to people. It depends. There's obviously Chat GPT or whatever your favorite flavor is, Gemini or Grok.
Oh,
But
yeah.
but if you take now I've got the paid version of Chat GPT. It's $20 a month. But you can take in an Excel spreadsheet, I can put all of my medical history, just kind of broad-based things that I
Mm.
have. You can put it in there, then have Chat GPT grab that. It'll structure all that data, and it'll start giving you some potential outcomes like, hey, you might be at risk for this or this here. Then you can cross-check it. You can take what ChatGPT has come with there, and you cross-check it with Grok, or you cross-check it with Gemini and get some other pieces. But it's very, very interesting now. There's people like doctors used to hate the fact when people would walk in and they would think that they were Mr. or Mrs. Google, right?
Right.
This is ChatGPT is very, 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 very different because it's grabbing databases that have information. And you're seeing doctors. One of my research guys, he just came back from the dentist, and the lab technician that was reading the X-ray, when the dentist came in, the dentist put the picture into Chat GPT to confirm, saying that, oh, it's just a stain, it's not a cavity. So you're
Wow.
going to see way more of that going on here.
Yeah.
And the same thing happens, again, having kids. We all know if you have young kids here, if you can Chat GPT, instead of having to put the kid in the car, even go to urgent care. I know urgent care is less onerous than an emergency visit, but still the
Yeah.
urgent care is now, they're backed up with tons and tons of people, and they
Right.
don't quite know. You can take a rash that a kid has, take a picture, throw it in there. You might have better outcomes on that
Yeah.
than having to go through all the rest.
Yeah, it is really amazing. I have a friend who just started a new relationship, and she's been consulting ChatGPT for the relationship advice. Should I text him now or not?
I love it.
So
Woo.
interesting.
Uh,
All right. Well, we're veering. This is always fun when we start
yeah.
veering off topic, but last call for questions. Anybody have anything they want to throw at our friend Kim here? Um, and of course, you can always reach out to me, and Kim's just delightful to have access to him. So responsive and always great to see you at the conferences, and looking forward to
I
the next one.
I love it. I'll leave you guys with one last piece there that you may have heard, but I just want to reiterate it.
Great.
The baby boomers have 80 trillion, that's with a T, of savings right now. Okay. It's kind of their net worth there. And that money is, I think COVID did change the behavior dramatically for the baby boomers, where a lot of them were going to, they were basically going to save that money until they passed away, and then they were going to pass it down. Now you're seeing them where I'm being a little facetious, but they literally are spending that money like they want their last check to bounce.
Mhm.
And that is a big stimulative effect for the overall economy. And that's one of the reasons why, and it's not long-term sustainable, that 10% of the population is 50% of the spend. It's 50%. And a lot of that are the baby boomers that are aggressively, taking trips, going out to restaurants, they're doing experiences, they're helping the kids and the grandkids buy houses. But that is a big, big, big transfer that's happening while they are alive. So once again, Chablis, thank you guys very much. Really
Absolutely.
appreciate the partnership, and thank you to all of your clients for your time. Really appreciate and respect the fact that you guys are giving Chase and my firm a chance to talk with you guys.
Of course. We really appreciate your time today. Everyone get out there. I see the sun breaking out. So everyone get outside and get some sunshine. Great to see you all. Call anytime.
Awesome. Sounds
Thanks
good.
again, Kim.